Alright guys, welcome back to Wealth and Travel on a Dime. So today we're going to talk about the no Nav Erosion portfolio strategy. So this is a strategy we created in order to A, optimize income from our portfolio, and B, to prop it up because we are in depreciating assets. Okay, these are income funds. They do have Nav erosion, some of our more aggressive ones, so that needs to be something you take into consideration when you're investing in doing this style. Now, none of this is financial advice. This is entertainment purposes only. Gotta say it. It's a new thing that's getting real bad. So I'm not telling you what to invest in. I'm just showing you how we do. This is for your entertainment. Now, let's talk about Nav erosion, what I mean by that. Now, some people say Nav erosion's a myth. I'm not going to argue with you. You're allowed to believe whatever you want. But in my portfolio, I know that as I buy an asset and as it pays out, much like if you bought a vehicle and the mileage went up or the years went up, it goes down in value. That's the same thing that's going to happen with a lot of these higher income assets. All right, as the income comes out, you are going to be worth less. Now, when the share price goes down, the yield also goes down. So if you're getting $1 here and now it's worth this much, the percentage is going to give you less. So maybe you make 90 cents after the first year. Maybe you make 85 cents the next year off each share. So we want to make sure that we're keeping our account balanced out. We're getting pretty much the same amount of dividend as much as we can every month. And the share price is staying up because the value is going down. It's worth less if you ever decide to sell the portfolio later. So we are going to make sure our portfolio does not erode over time through various methods. But, honey, you really need to talk about what the portfolio makes in order to understand what we can do.
So currently, we make an average monthly of $5,000 to $7,000 on our dividends. But we also sell options on those portfolios, and we make an additional approximately $2,000 monthly, and that is off of $175,000 portfolios.
That's correct. Now we sell those options using margin. We're not actually selling on the positions in our portfolio. That allows us to have two incomes from one source. Now, with that 175K portfolio, it's going to fluctuate. Okay, the market moves up and down, so that's normal. But you can basically get to a point where you're higher than that. That way when the drop happens, it's not a big deal. But the Nav erosion is what you want to make sure that is not eating you up. So to make it very easy, to ensure that we will have a portfolio of 175K, if it ever drops below that number, then we will reinvest our option income. All right, we will take the money that we make weekly from options, which over a month is $2,000 basically, and we will reinvest that in. Now, there is the reality that at times the market does have heavy dips or even crashes. If that were to happen, we would reinvest our option premium and a percentage of our dividends, which would be figured out when it happened, how much we want to reinvest. But what's going to happen is when the recovery happens, you're going to end up above that 175K because you've reinvested. So it's less likely the next time that you're going to fall below the 175, if that makes sense.
But it's important to note that whenever we are reinvesting, we are reinvesting into safer assets with 25% yield to slow down the Nav erosion. That way it doesn't erode as quickly and we're getting into safer and safer.
Yep. So by doing that, we allow ourselves to future-proof somewhat. Now, in a bull market and, everything's going sky high and we're staying above 175K, there's no reason to do much reinvesting. These are the times when we should be pulling the money out, maybe even saving a little bit like a bucket strategy, or even just spending it because these are the good times. So in that case, we would pull all of our dividends and our option premium and not reinvest anything, which is what we've been running here lately. Now, it is going to go up and down. You cannot have a market that's just flat stable unless you're doing like treasuries or something. It's just not. You're not one for one, you know. So expecting that, we don't get in a hurry. If it goes down for a day or two, we don't go running to put money in. Usually it has to be under the 175,000 for at least a week. So, you know, that's just how we look at the whole portfolio on scale. It seems like a lot of information, but it's really simple. 175. If it goes below that, we reinvest our option premium. We're still getting to take out all our dividends and spend them. All right? If it's above, we take everything out. Just that simple. But there is more to our portfolio on whole than just that, right, honey?
So it's important to remember we also have retirement accounts. So we both have Roths, we have a individual retirement account, and these accounts have both a mixture of aggressive and safer investments, and we can always fall back on them. So that gives us peace of mind that even if this fell quite a bit, we would still be okay.
Yeah, it's not going to unretire us if our income dropped a lot. We could take the tax hit and start living off those portfolios if we really had to. But it's always best to have a backup plan. And I will say it's always good to have an account in the background somewhere with like standard index ETFs, you know, that are very safe. You know, a total market fund would be fine. Just something in the background working quietly to protect you in the worst case scenario. This is not for everyone. All right. This is not a set it and forget it strategy. This strategy is rather advanced. These funds and how they work is rather new. So it's always open for change. But if you think about the fact that we are retired on $175,000, we do make some extra money off YouTube, not very much. We do make a little money right now because my wife likes to do her little Walmart Spark gig work and stuff. So, yeah, we make a few dollars outside of that. But our numbers are out there on our community posts and our Facebook pages every single month. You can see exactly what we're making. We're very transparent. And it's been working for year plus. You know, we actually retired, but we have numbers from before the first of the year when we actually, per se, semi-retired.
Right.
The strategy works. How it works for you is based upon what you want to do. You may just be like, I don't want to do options. I just want to do dividends. And I'll reinvest a percentage of my dividends. And we'll be doing a Retire On series soon where I will break down multiple different single stock ETF options and single stock tickers that you could retire on, how much you need to reinvest, and we'll just look at each of them one by one and be able to take a deeper dive if you were trying to do it without selling your own options. So make sure you subscribe if you want to see that, and if you haven't already, please go down, give us a like, talk to us down in the comments. What do you think? Could you run a portfolio like this? I really think that it is very easy if you pay attention and you're not afraid to do things like record your income, because you'll never know how much you're truly making unless you're using, say, a spreadsheet or something to track how your income in and out is going and how much you're reinvesting, etc. Because you never know where the real numbers are. Could you take the time to be able to save enough money to do this? A lot of people are like, I'll never save $1 million for the 4% rule, you know, in regular retirement. This is a way you need a lot less cash. Could you save 175? Could you save 150? Could you save 200,000? Because any of those numbers would give you an awful nice income, I think. But with that said, we will see you in the next one.